So my name is John Saygraves. I'm an advisor with the credit union. I've been with the credit union for almost 10 years now. And I'm what we call within the organization, a centralized advisors. I no longer work out of the member centers. So I'm located at our offices over in Beaver Creek. And you have entered into the retirement saving challenges for women. And we have a lot of information to cover. I hope to keep it right about an hour, hopefully under that. And but we'll go ahead and jump right in. These are just some general disclosures. And so the first things that we're going to mainly talk about are the specific challenges or the special challenges that women face specifically when it comes to planning for retirement and retirement income. And first of all, women generally live longer than men, which is a good thing, but it also means that they may need to plan for more years in retirement and more years that their retirement income needs to last. So because of their longer life expectancies, women should also consider that they may spend some of their retirement years living on their own. And their careers are often interrupted to care for children or sometimes even aging parents as well. And because of these interruptions, women may spend less time in the workforce, which can lead to earning less money than men in the same age group, could also result in saving less for retirement and also having lower Social Security benefits. So, you know, when you bundle all these things together, they provide some unique challenges that women sometimes have to overcome. So it's important to recognize these challenges and plan accordingly. And we're going to look a little bit more closely at each one of these challenges specifically. Statistically, all other things being equal, women are likely to live longer than men of their same age. In itself, it's not a bad thing, but it also means that you may need to plan for more years in retirement. So at the age of 65, a woman can expect to live on average an additional 20.6 years compared to only 18 years for a man. And the reason, or some of the reasons that can be a challenge is, you know, sometimes in marriages, there's age gaps. What I mean by that is there is I'll use myself as an example. My wife is 5 years younger than I am. And so there's some unique challenges that come along with that as well in regards to healthcare and Medicare and things of that nature. But just from an income planning standpoint, if I were to retire at age 65 and my wife is age 60 and I live to say age 85 and she outlives me by 5 years and lives to age 90, well, our retirement income has to last me 20 years, but it has to last her 30 years. Okay, so you know, those age gaps or in that longer life expectancy for females is something that needs to be accounted for and planned for accordingly. Women also have a higher likelihood of living on their own in retirement. According to recent statistics, older women are much less likely to be married than older men. 46% of women are married compared to 70% of men. In addition, 33% of women age 65 and older are widowed and 16 are divorced. So almost half of all women age 75 and older live alone. Okay, so that's you know, for whatever the reason, it's just kind of how the numbers play out. And so, you know, it's something that women need to prepare for and plan accordingly for when it comes to their retirement planning and their income planning. And so for married women, the loss of a spouse could mean a reduction in retirement income from both Social Security and or pensions. Women are also more likely to take time out of the workforce to raise children or care for aging parents. Sometimes this is by choice, but moving in and out of the workforce, as we mentioned before, has several significant financial implications for women. Lost income and employment benefits, such as retirement benefits and health insurance, often means potentially lower savings. A potentially lower Social Security retirement benefit is also another impact, and this is because your benefit for Social Security is based on the number of years you've worked and the amount that you've earned over that time. Economic vulnerability in the event of divorce or a spouse's job loss, and possibly a more difficult time finding a job or a comparable job in terms of pay and benefits when re-entering the workforce. Even women who do remain in the workforce are much more likely to request flexible work schedules to meet primary caregiving responsibilities, which can affect their salary and long-term career advancements. So, all of these different impacts or challenges that women faced ultimately add up to lesser income, and as a result of lesser income leads up to lower retirement balances or balances within your nest egg as you do approach retirement. Women who generally earn less than men, according to the Bureau of Labor Statistics, women who work full-time earn on average about 82% of what men earn, okay? This wage gap can affect overall savings, Social Security, retirement benefits, and for those lucky enough to have one, it can have an impact on pensions as well. It also means women are more vulnerable to unexpected economic obstacles, such as job loss, divorce, single parenthood, illness, or the loss of a spouse. And so again, all of these things add up to having lower income, lower savings when it comes to retirement planning. So how much annual income will you need when it comes to retirement? It's often stated that you should plan on needing somewhere between 60 to 90% of your pre-retirement income when you do retire. And while this is a nice, convenient, easy method to calculate your retirement income, it's very simplistic. The general guidelines like this one aren't really helpful because they don't take into account your individual circumstances, your expectations, and your goals. And so as you get closer to your retirement years, we try to do, as we're doing more comprehensive planning, we try to get more specific in what your plans and what your specific goals are and needs to really identify in more detail how much annual income you'll require during your retirement years. It's fine to use a percentage of your current income as a benchmark, but it's more important to focus instead on all of your current expenses and to really think about how those expenses will change over time as you transition into retirement. For example, you have some expenses like a mortgage, the cost of commuting to and from work may disappear during retirement. Other expenses may increase, like large yard care or snow removal services, home maintenance, things that you might currently take care of yourself, but you may not want to or may not be able to do in the future. And so when you're starting to forecast out what your needs are, your expenses are, we always try to break those up into two different types of expenses. You've got your basic living expenses, the expenses that you can't really get away from, um, gas, groceries, utilities, property taxes, insurances, those types of things. And then you have what I would call lifestyle expenses. And, if you're going to be traveling, hobby expenses, um, things that are a little bit more discretionary, would be more of your lifestyle expenses. And so we try to separate those two things out, and then plan accordingly from there as far as how much annual income you'll need to cover those. Uh, though it may be difficult, listing your expenses and projecting how much you'll be spending in each area when you retire is really crucial. Okay. The other thing to plan for in retirement that is often overlooked is accounting for inflation. And when you estimate your projected expenses in retirement, you can't assume that things will cost the same as they do today. You've got to consider the potential impact of inflation on those expenses. Inflation is the risk that the purchasing power of a dollar will decline over time due to the rising cost of goods and services. So things just get more expensive over time. Inflation is often overlooked when planning for retirement and can have a very drastic impact on someone's successful retirement plan. And what you're seeing with this chart is that if inflation runs at a historical long-term average of about 3%, a given sum of money would lose more than half of its purchasing power in a 25-year period. So for example, at 3% inflation rate, a gallon of milk that costs $4 today, would cost $8.38 in 25 years. So all other things being equal, inflation means that you'll need more retirement income each year just to keep pace with the rising cost of goods and services. And to outpace inflation, you need to have a strategy in place that allows your income stream to grow and increase throughout your retirement years and not just stay the same. I always kind of tell folks, obviously, 25,000 in income today is not going to be the same as 25,000 in income, in 25 years or 20 years. Okay, you've got to adjust that income for the rising cost of goods and services. Okay. The other thing to consider is that the inflation rate in regards to healthcare cost is almost double of what all the other expenses are. Okay, so when we're doing some financial planning for folks here, we try to separate those healthcare expenses out from regular expenses because, again, the inflation rate on those is so much higher. Like inflation, taxes are another important but often overlooked aspect of retirement income planning. Taxes can certainly eat into your income, significantly reducing the amount that you have available to spend in retirement. So you want to make sure you understand whether the income you're counting on is taxable or is not subject to tax. Okay, so for example, private pensions are generally fully taxable. You might also be surprised to learn that a portion of your Social Security benefits may also be taxable, depending upon your filing status and the total annual income, for any given year. So keep in mind that some income, like interest, is taxed at ordinary income tax rates, and other income, like capital gains and dividends, at this point benefit from generally lower tax rates. Okay, some specific investments like municipal bonds, they'll generate income that can be exempt from federal income tax and sometimes state tax as well. And then you've also got to look at how distributions from tax advantaged accounts like traditional IRAs, 401ks, thrift savings plans, 403bs, how those things are taxed. Generally, distributions from those accounts are also going to be taxed as ordinary income, regardless of whether the investments within the account may have generated long-term capital gains or dividends. And then there's special rules that apply for Roth accounts, 401ks, IRAs, Roth 403bs and 457s, deferred comp, things of that nature. So qualified distributions from those accounts, which are funded with after-tax dollars, likely are free from federal income tax. Okay. Finally, when you're calculating how much retirement income you'll need, one of the most important expenses that you need to consider is healthcare. And we talked briefly about this in terms of inflation. Not only does a longer life expectancy mean more retirement years to plan for, but it also means you'll likely spend more on healthcare for premiums and uninsured expenses as well. So for a married couple, there's the risk that savings may be depleted by healthcare costs relating to the passing of the first spouse, which would then reduce the amount available for the surviving spouse. Okay. In addition to general healthcare premiums and expenses, many women will have a need for long-term care because they are more likely to be living on their own in the later years. And so if their health were to begin to decline, their spouse has passed on, maybe they don't want to trouble the kids for that care. And so, the cost of ongoing services and support needed by people suffering from chronic health and health conditions or disabilities, that care can get to be pretty expensive. And quite honestly, while many people fear market risk, I believe that declining health is one of the greatest risks for people when it comes to the success of their financial plan. It's not market risk. It's declining health risk is really the greatest area of risk. It's hard to face the fact that our health might decline, but statistics suggest that about 57% of women will need some type of long-term care services at some point during their lifetimes after the age of 65. And that care can be very expensive. Currently, the nationwide average for monthly cost of a semi-private room in a nursing home is about almost just over $6,800 a month. But if you don't need that highest level of skilled care, there's other less expensive options, which would include assisted living facilities, adult daycare centers, and home health aides. But even with those options, I mean, quite honestly, you're still looking at $4,000 to $6,000 a month, just for those types of services as well. I think many people assume that Medicaid will pay for those long-term care costs, and that you may be able to rely on Medicaid. But the thing you've got to keep in mind is that Medicaid is a low income program. And so in order to qualify for Medicaid, your assets and your income must be low enough for you to qualify. And so what basically happens is, they're going to force you to pay for that care out of pocket until your assets get low enough to where you will qualify for Medicaid, and then they would come in and pick up the tab. So, don't just assume that Medicaid's gonna start out paying for things from the get-go. Another option is to basically consider long-term care insurance, which may provide a source of funds for those types of expenses, but doesn't necessarily ensure that you won't have to pay for some of the cost out of pocket as well. The premiums for the insurance would also need to be factored into your retirement income needs. Okay, so it can get pretty complicated, when you're trying to plan for declining health scenarios and the added cost that go along with that. Now that we've talked about how much annual retirement income you're going to need, um, we probably should discuss how long that retirement income might need to last. Okay, so when it comes to your retirement, really how long the period should you be planning for? So, we already mentioned the good news is that we're living longer. The bad news is that generally means your retirement income will have to last for a longer period of time. And, depending on how long that is, I mean, it's likely that some folks are going to live into their 90s, late 90s, even early 100s. And that longer period of time can certainly create strain on the overall finances or upon your nest egg. As I mentioned earlier, the average 65-year-old woman in the United States can expect to live another 20 years, but again, that's an average. So that means, some ladies are living into their hundreds, living an extra 30, 35 years. And, of course, some are passing away in years 1 and years 2 of their retirement. So, I always tell folks we like to overplan and not underplan. We don't want to plan on you passing away at age 85 and then lo and behold, you live to age 90, 95 and financial resources are scarce. So we want to make sure we overplan when it comes to retirement. Life expectancy has increased at a steady pace over the years, and it's likely to continue to increase. And so it's not unreasonable to plan for a retirement that would last for 25 years or more, which means your income and your savings needs to last that long as well. So where does income come from for retirement? Traditionally, there's what's called the three-legged stool, which basically just illustrates the three sources that retirement income would come from. The first is Social Security retirement benefits. Then you have traditional employer pension income. And then finally, individual savings or investments. The first two legs of the stool, Social Security and pensions, produce a steady, relatively fixed stream of income that you can depend on during retirement. But quite honestly, less and less people are qualifying for employer pensions these days. And so we're going to kind of jump into each of these individually. And first one we're going to take a look at is Social Security benefits. So today, 94% of U.S. workers are covered by Social Security. Social Security is a major source of guaranteed lifetime income for most Americans. For some women, Social Security makes up most, if not all, of the income that they have in their later retirement years. So to qualify for Social Security benefits, you have to work in a job that's been covered by Social Security, and you generally need to have earned 40 credits, which is about 10 years of work, okay? So if you haven't worked long enough to qualify on your own, you may qualify for spousal benefits, okay, based upon the work record of your spouse. So a spousal benefit claimed at full retirement age is generally equal to 50% of the primary earner's benefit, okay? So you can either qualify for Social Security benefits on your own personal work record or upon the work record of your spouse, okay? And those spousal benefits, again, would be about 50% of the benefit of your spouse. And so if you have the ability to choose between your personal work record and your spousal benefits, then you have the means to take the higher of the two, okay? You have the choice that you could either take a spousal benefit if it is indeed higher than what your own personal benefit would be, okay? So how much can you expect to get from Social Security? The amount that you'll receive from Social Security is based on a number of years that you've worked and the amount that you've earned over that period of time. Your benefit is calculated basically using a formula which takes into account your 35 highest earning years. Okay. If you earned little or nothing in several of those years, it may be to your advantage to work as long as possible, because you may have the opportunity to replace a year of lower earnings with a year of higher earnings, which would ultimately increase the Social Security benefit that you'll qualify for. Another plus is that Social Security's annual cost of living increases are calculated using your initial year's benefit as a base. And so the higher the base, the greater your annual increase will be whenever Social Security provides a cost of living adjustment. Also keep in mind that if you're married and your lifetime earnings were lower than your spouse's, you may be able to generate a spousal benefit based upon your spouse's earnings. We've already talked about this, which could be higher than what your own work benefit would be. An unmarried divorced spouse who was married for at least 10 years may be eligible for that spousal benefit. The age at which you start taking benefits will also affect how much of a benefit you will receive. You can choose to start taking benefits as early as age 62, but if you do, your monthly benefit will be 25 to 30% less than if you had waited until your full retirement age of either 66 or 67, basically just depending upon the year you were born. On the other hand, you'll receive a much higher benefit if you delay claiming Social Security until age 70. If you wait, your monthly benefit will increase by basically about 8% each year that you delay taking a benefit past your full retirement age. Even if you claim benefits at age 62 and receive a smaller benefit, you'll end up receiving more benefit checks, but they'll be at lower amounts. What we often do when we're looking at folks' financial plan is we'll use what's called a break-even calculator, which basically will forecast the ages when your retirement benefits at 62 would equal your total payout of benefits for ages 66, 67, or even age 70. This basically tells us how long you have to live before postponing benefits would have been more advantageous to you. Okay. And so we also do this as part of the financial plan and see, which of these is going to have the greatest impact on your financial plan, giving you the highest probability of success. This next chart basically just shows a hypothetical person where what they might receive in Social Security benefits at different ages. It's based on a full retirement age of 66 and a benefit of $1,800 per month. And as you can see, if you start taking that benefit at age 62, they'd only receive $1,350 a month. But if they waited till age 70, they would receive $2,376 a month. And so, that's about $1,000 more. So remember, this monthly benefit is guaranteed every month for as long as you live. The other thing that's important to consider here is a survivor benefit. And so, if you're married and you were to predecease your spouse and their benefit was lower than yours, then their benefit would get stepped up to the higher benefit. So the longer you can postpone your Social Security benefits to increase that monthly income amount would also have an impact on potentially the spouse whose benefit is lower, and theirs will get stepped up to the higher amount also. Okay, they're going to lose upon the death of one of the parties. the lower income for Social Security is going to be lost. Okay. So that's something that has a significant impact as well. We're going to move to kind of the second part of that three-legged stool, which is basically employer pensions. And if you or your spouse is lucky enough to have a pension, and entitled to receive a traditional pension, you're in the minority there. Fewer Americans are covered by such plans every year. Pension benefits can be complicated, and it's really important to make sure you understand how they work and what the options are that you're signing up for, because typically those, once elected, they're irrevocable decisions. A typical pension benefit is payable monthly over the plans, over the participant's lifetime, starting at normal retirement age, which generally is age 65. This is called a single life annuity. Okay, so understand a pension is basically a annuity that gets annuitized, meaning you're kind of relinquishing control over the balance that is generating the income. Okay. If you're married, you have the option, and federal law requires that benefits be paid. You have the option to do what's called a qualified joint and survivor annuity, so that if you were to pass away, those benefits, even though they may be lesser, those benefits would still pass on to your surviving spouse on some level. Okay. So, like I said, at some level, those benefits can be reduced anywhere from 50% or more or less. Basically, what happens is when you select your annuity payout options, you might select a lower amount so that your spouse would get some level of income upon your passing. Okay. If you're entitled to a pension, your choice of whether to receive the pension benefit as a QJSA or in some other form may be one of the most important decisions that you're going to make. Again, those decisions generally are irrevocable. So we're going to take a look at what an example might be of a pension plan. Okay. So you can see, again, these numbers are strictly for illustrative purposes, but suppose your spouse retires at age 65, having earned a pension benefit of $4,000 a month, payable for their lifetime. So for a single life, okay? That single life annuity benefit upon his passing would basically be zero if he were to have passed away. Okay, so you can see he's getting the highest payout, but there is no surviving benefit. Now, the QJSA is payable over a longer period of time, right? It's payable over both lifetimes. And so the amount paid to your spouse while he's alive is reduced. Let's assume that under the QJSA, your spouse will receive $3,800 a month, and then after his death, you would receive 50% of that amount, or which obviously is $1,900 a month. Okay, that's a 50% payout. You might also have the option to receive 100% payout. So again, your spouse is going to elect to take $3,600 a month, lesser than the other two options, but there's 100% payout to you as the surviving spouse, which is also, $3,600 a month. Okay. So it's tempting to take the single life payout because it provides the highest level of income, but you've also got to consider, what happens if that spouse passes away, and what does your income look like if that income is either reduced or negated, entirely. Okay. So as a female, if you have earned the pension benefit, it may make more sense to waive the survivorship option and take the larger single life annuity benefit, because the likelihood that you'll outlive your spouse. Okay, but again, don't just want to paint a wide brush here. That's where every scenario, every household is unique, and you've really got to make the decisions that are best suited for you. So we're going to recap for a moment and just kind of talk about, the level of retirement income, and we're going to do what's called identifying the gap. We've talked about estimating how much annual income you'll need in retirement. We've also talked about how much income you can expect from employer pension plans and Social Security. And if you compare these two, you're likely to find a gap or a shortfall. Unless you're lucky enough to have a very generous pension, you're going to have unmet retirement income needs that will have to be funded by the third leg of that stool, which is basically from your personal savings, your investments, your nest egg, so to speak. Okay. So when we're talking about your personal savings, we're talking about funds that you have in tax advantaged accounts like IRAs, 401ks, 457 plans. I would say it even consists of monies that are just sitting in checking and savings accounts. I mean, everything that's liquid assets for you is part of your nest egg and should be leveraged or used to provide a plan that's going to not only provide you steady monthly retirement income that is increasing over the years, but should also be used to provide for the occasional lump sum withdrawal as needed, for emergency needs or other projects. Okay. Statistically, women earn less than men in similar jobs, and they are more likely to work part-time. And so, because of that, we've already talked about how that translates into lesser income. That can also be caused from caregiving responsibilities, which also translates into fewer years in the workforce. And the combination of these factors, you might not have enough savings in retirement, really, unless you plan properly. Okay. These factors explain why many women are at a disadvantage when it comes to saving for retirement, which makes it vital that you take the necessary steps to identify and address any projected shortfalls. Okay. So with all the challenges that women face, what is it that you can do right now? Okay. To state the obvious, the first thing you can do, the number one thing, is to start saving. Saving now, saving more. Okay. I've never had anyone come to me at retirement and say, I wish I would have saved less. It's always the opposite. I wish I would have saved more. So the sooner you can start and the more you can begin to save, you're just paying your future self. So for example, if your employer offers a retirement savings plan, such as a 401k or a 403b, start contributing at least up to the matching point of the plan. If you're contributing the maximum amount to your employer retirement plan and you need additional options, or if your employer does not offer a plan, then consider contributing to an IRA. Okay. And we'll talk more about these plans in just a few moments. The other thing that you can do is just become a more knowledgeable investor, become, more educated. Some of you here today may have handled your family's finances all along. Others may be new to the world of investing. I find that every household typically has what I would call a CFO. There's always one person that seems to handle the finances of the household. And where it really becomes a challenge for folks is if that CFO is the one that passes away first, then the other person is really trying to play catch up and get a good handle on where they stand financially and what the financial plan looks like, for the long term. So this is where, working with a financial advisor can really help. plan accordingly in either scenario, okay? This is an example of how saving a little bit extra each month could turn into a lot more during your retirement years. We're going to assume that Jane and Sally both earn $50,000 a year from their jobs. Jane saves 5% of her salary each month, while Sally saves 8%, okay? And you can see, you know, those monthly savings amounts are $208 and change versus $333 and some change. So over a period of 15 years, Jane will have saved $37,500 and Sally will have saved $60,000, you know, roughly about $22,000 more, okay? Now, if Jane and Sally both earn 5% a year on their savings or their investments, Jane's savings would be worth $55,000 plus in 15 years, and Sally's would be worth over $89,000 in 15 years. And so that's an increase of about $33,000. So again, just saving a little bit more, saving what you can translate into significant differences over the years at retirement, okay? We're going to talk, as I mentioned, we're going to talk a little bit about employer plans and IRAs. Probably the best way to accumulate funds for retirement is to take advantage of the special tax advantage retirement savings accounts, okay? A 401k plan and other employer-sponsored plans can be very powerful savings tools because your contributions come out of your salary on a pre-tax basis, okay? So you're reducing your taxable income now, accumulating wealth tax deferred until ultimately it's withdrawn down later on down the road, okay? Having your contributions deducted directly from your paycheck can make it much easier to sock away money versus savings, saving what you have left, okay? There's the idea or the saying, you always want to pay yourself first. So this allows you to pay yourself first as that money is just payroll deducted. If your 401k plan offers a Roth option, you may be able to make those contributions to the Roth and fund it with after-tax dollars, okay? Roth after-tax contributions don't provide you with any immediate tax savings, but they allow you to make withdrawals in retirement free of federal income taxes later on, okay? So essentially you're gaining tax-free growth over time. Finally, 401k plans often include employer matching contributions. So they will basically provide a additional contribution above and beyond what you're putting in, which if you're not taking advantage of that and your employer offers that, you're basically leaving free money on the table. But your contributions with the employer matching can be an excellent way to kind of boost your retirement savings over the years, okay? So that's really the first place you should be starting to save and invest is in your company, your employer-sponsored retirement plan, especially if they're matching, because otherwise, you know, you want to take advantage of that, all that income, that free money, so to speak, okay? Traditional Roth and spousal IRAs can also be used as savings vehicles. Traditional IRAs like 401ks feature tax advantaged growth. They can lower your current taxable income, and Roth 401ks and IRAs, you're funding it with after tax dollars so that you're able to make tax-free withdrawals later on. A lot of times what I will see is that folks have always been putting money into pre-tax accounts, and those accounts are going to be taxed at retirement. And while that's okay, the problem is that those folks have painted themselves into a corner where basically every dollar that they need in retirement income is going to be taxed. It would be nice to have some Roth IRA dollars that are being contributed to as well, so that you will have some tax-free income at retirement, and you're giving yourself more flexibility in regards to where you want to make those withdrawals later on. But if you don't have any Roth accounts, again, you've kind of painted yourself into a corner to where every dollar that you need in retirement is going to be taxed for you. Okay. What can you do if you find out that you have a shortfall? Once you're factoring in your personal savings, your projected income still doesn't meet what your projected expenses would be. The best solution for dealing with a shortfall will depend really on how much of a shortfall there is, the length of time remaining before retirement, and how long you need your retirement income to last. But there's a few things that you might want to consider. First of all, spend less during retirement. Okay, that's nothing anybody likes to hear, but that is one option. Maybe you've got to cut back on the lifestyle expenses. The idea of traveling, having a lot of extra hobbies and discretionary spending, that stuff has to go first, unfortunately. Another option is that you might delay retirement. So, if you were looking forward to retiring at age 65, maybe you've got to plan on retiring at age 67 or age 70, whatever the case is. Maybe you work part-time during retirement. Okay. There's a lot of benefits to work besides the financial. I mean, there's structure to your day. It keeps you engaged. There's a social aspect, where you still, have maintained friendships through people at work and things of that nature. But working during retirement's a viable option as well. There can also be other potential sources of retirement income, and we'll talk about some of those here in just a moment. But there are some advantages to delaying retirement. Basically, by delaying retirement, the longer you work, the longer you'll be able to continue contributing to your retirement savings. Okay, so you have more accumulation years. Even if you're no longer adding to your retirement savings, delaying withdrawals out of retirement can also have a significant impact, because now you're shortening the period of time for how long those withdrawals will need to last. As we discussed earlier, delaying retirement may mean you can postpone your Social Security benefits, which would provide an increase to what your benefit would be when you eventually started it. And continued employment may also allow you to continue access company-sponsored healthcare. Okay, so to where you're not having to pay higher premiums or out-of-pocket premiums for that. So again, there are some advantages to delaying retirement. There will be some advantages if you plan to continue to work in some capacity during retirement as well. The obvious advantage is that you'll be earning money and relying less on your retirement savings, leaving more of your savings to potentially grow for the future and helping to stretch how long that savings will last. In addition, full or part-time work during retirement could provide, again, more access to healthcare for a longer period of time. If you do work during retirement, you want to make sure that you understand how the income you earn might affect your Social Security benefits. While your earning increase may, while your earnings may increase your Social Security benefit in future years, current benefits could be reduced. So if you have started taking Social Security at the age of 62 and you're working beyond that, then there's going to be a decrease in your Social Security benefit for every dollar that you earn over, it's about $18,000 is the limit. So anything that you earn over $18,000, your Social Security will be reduced if you started that benefit at age 62. Now, once you get to full retirement age, of 66 or 67, doesn't matter how much you earn over that $18,000 limit. You can earn as much as you want without a reduction in your Social Security benefits. But if you have started those benefits early, make sure you understand how the payroll income that you're receiving might have an impact on that benefit. And again, we've talked about the non-financial benefits of continuing to work, the social interaction, the sense of accomplishment, structure that has, that your day has, so you might decide to launch a new career or even start another business or whatever the case is. But there's a lot of benefits, non-financial benefits that come as a result of working. Okay. Excuse me. One last observation while we're on this topic is if you're working for an employer that offers a traditional pension, determine whether working part-time will affect your benefits. If your benefit is based on your final average pay, it's possible that working part-time could reduce your benefit amount. If you are obviously decreasing that pay due to part-time work. It could also be worth inquiring about how any phased retirement program that your employer might offer. These programs basically allow you to receive all of your pension benefit while you continue to work on a part-time basis. It's kind of what they call double dipping. You retire from your employer, they pay out the pension, they rehire you back to where now you're receiving the pension and the additional payroll income as well. So you get the double dip. As we mentioned, there may be other potential sources of retirement income that might be available to you. For example, if you built up substantial home equity, it's possible that you could tap that equity as part of your retirement income, either by selling the home or by borrowing against the value of the home. These to me, with leveraging your home for income, you hear a lot about reverse mortgages and things of that nature. To me, these are probably last resort scenarios. If you have exhausted every resource you have to generate retirement income, but you still need more income, okay, this might be an option. Another example is using cash value from permanent life insurance policies. That again can be another source of income. Do you still need those life insurance policies? Is that cash value declining each year? And if it is, it might be worthwhile, to evaluate those policies and utilize that cash value in other ways. Okay. We're going to transition here for just a moment. I'm going to show you kind of a 2-minute commercial that kind of goes into some of the resources that we have available for retirement planning. And I'm just going to go ahead and let this run for a couple of minutes. After this is over, or once you exit out, there is a short survey. I think it's 3 or 4 questions long. If you wouldn't mind just taking a couple minutes to answer those questions. But then we'll see if there's any questions that that I can try to answer as after this initial presentation as well. So give me just a minute.
Life changes, and it's important to be prepared for those changes. Welcome to Money Guide Pro, the groundbreaking financial planning software that sparks the important planning conversations and helps you create your own personalized plan for your life and retirement. The experience is simple. We start with the easy stuff, your personal information. Then move to the exploration of your personalized goals, which are the heart of a quality financial planning. Your goals are divided into needs, wants, and wishes. Not all goals are equal. This will help us prioritize what is most important to you. Buying new cars, paying for college, providing care for a loved one. We'll address each of these and learn what is important to you and why. We also address those items you may not be thinking of. So it's important to include healthcare costs into your goals and discuss longevity to make sure you're protected. Next, we evaluate the resources you have available to fund your goals. We review everything from retirement income, pension and Social Security, to investment assets and insurance, or other assets such as a home, rental property, or business and stock options. Do you have liabilities? We can enter those too, and then view your net worth statement. We'll discuss risk and decide how much risk you're willing to take. You have one question: can I fund all my goals without running out of money? We provide an easy to understand result called the confidence meter, which shows you your probability of success. If you want to see more detail within the result, you can drill down into each individual trial or view a year-by-year breakdown. The plan may not end up in the confidence zone initially, so we'll make recommendations to get your plan into the confidence zone. One of the most interactive tools, the Play Zone, allows you to instantly see how changing some of your expectations, when to retire, and how much to save can impact your plan. We can also test the effects of risks outside of your control. Most importantly, your financial plan isn't static. It will adjust with you over time, and we will continue to review and make improvements as your life changes. You'll be able to view your plan through easy online access and see your dreams come into reality.
All right, guys, that's all I have today. Here's my contact information. I don't see any questions through the chat room. So like I said, if you just take a couple minutes to answer the questions as you exit out, I would appreciate it. If you have any questions that you want to talk offline, so to speak, feel free to call me or email me, and we'll help you as much as we can. Have a good day.